Big tech is not running out of money, it is running out of something far more dangerous, the old business model that made these companies look almost invincible. For years, the largest technology companies sold investors a beautiful machine. Add another user, serve another ad, sell another software subscription, and the cost barely moved. Revenue could climb much faster than the physical assets needed to support it. That was the magic of an asset-light platform. Artificial intelligence is breaking that machine apart. The new version of big tech does not float in the cloud, it sits on concrete foundations. It consumes chips, memory, cooling systems, power plants, transmission lines, fiber networks, water, land, and billions of dollars before the first customer sends a prompt. And this year, 5 companies are preparing to pour roughly $730 billion into that physical empire. That number is so large that it sounds imaginary. But the cash flow damage is already appearing in real financial statements. In Meta's latest quarter, the company generated nearly $32 billion of cash from its operations. Then property, equipment, and finance leases consumed just over $31 billion. Free cash flow was left at only $784 million. 1 year earlier, it had been more than $8 billion. Amazon's cloud business is accelerating. Yet its free cash flow over the latest 12 months swung to an outflow of roughly $7.5 billion. Alphabet more than doubled quarterly capital spending to almost $45 billion and raised its annual budget again. Oracle generated record operating cash flow, but still finished its fiscal year with negative free cash flow of almost $24 billion. And then there is Microsoft, the strongest counterexample. Its cloud business is booming, its operating cash flow is rising, and it still produced almost $20 billion of free cash flow in the latest quarter. But even Microsoft spent $41 billion on capital investment in just 3 months, and it expects the next quarter to exceed $50 billion. This is the real AI story. Now, the question is no longer whether artificial intelligence can produce impressive products. It can. The question is whether those products can produce cash quickly enough to outrun the most expensive infrastructure race in corporate history. Because if they cannot, the AI boom will not end when the models stop working. It will end when a chief financial officer looks at the next data center invoice and finally says no. Before going further, we need to be precise about the $730 billion figure. It is not a single official bill. It is not money that has already disappeared, and it is not a clean measure of AI spending alone. The number comes from market estimates collected by LSEG for Microsoft, Alphabet, Amazon, Meta, and Oracle. In January, analysts expected their combined current year capital spending to be about $485 billion. By July, that estimate had exploded to roughly $730 billion. The forecast rose by nearly $250 billion in about half a year. The companies do not consistently separate artificial intelligence spending from other capital investment. Amazon's budget also includes robots, custom chips, and satellites. Data centers support traditional cloud workloads as well as AI, so it would be inaccurate to call every dollar an AI dollar, but it would be equally misleading to pretend AI is not driving the surge. Management teams repeatedly point to servers, accelerators, networking equipment, data center construction, and power capacity as the main destinations for the new money. These are the factories of the AI economy. And the estimate may already be too low. Amazon has raised its annual capital spending plan to about $220 billion. Alphabet now expects between $195 billion and $205 billion. Meta expects between $130 billion and $145 billion. Microsoft says its calendar year plan is still around $175 billion after an accounting reclassification involving leases. Add Oracle, and the industry is no longer debating whether the total is enormous. It is debating which accounting definition makes it look slightly less enormous. To understand why investors are nervous, forget earnings per share for a moment, and follow the cash a company begins with operating cash flow, the cash produced by its normal business. Then it pays for buildings, servers, chips, and other long-term assets. What remains is commonly called free cash flow. That is the money available to repay debt, buy back shares, pay dividends, acquire companies, or build a safety cushion. Capital spending hits cash immediately. Accounting profit feels the damage more slowly because the asset is depreciated over several years. A company can therefore report rising revenue, rising earnings, and even healthy operating margins while its free cash flow collapses beneath the surface. That is exactly why this moment is so easy to misunderstand. The income statement can tell you the AI boom is working, while the cash flow statement tells you the clock is running. The scale of the transformation is extraordinary. According to FactSet analysis, the five major hyperscalers spent roughly $95 billion on capital investment in fiscal 2020. In the 12 months through May of 2026, the figure was close to $490 billion. Estimates for fiscal 2026 exceed $690 billion, and projections move above $900 billion by fiscal 2028. This is not a temporary purchase of a few expensive chips. It is the conversion of the world's most profitable software platforms into industrial infrastructure companies. And the composition of the spending makes the risk more serious. Buildings can last for decades. Advanced processors cannot. Compute equipment is expected to represent about 3/5 of this year's capital spending, up sharply from only a few years ago. A larger share of the investment is now going into assets that must be upgraded or replaced as better chips arrive. That means some of today's capital spending is not a one-time bridge to the future. It may become a permanent treadmill. The companies are not merely building the factory. They may have to rebuild the heart of the factory every few years. No, look at Meta, because its latest quarter offers the clearest image of cash being swallowed in real time. Meta's revenue rose 28% to more than $60 billion. Advertising remained powerful. The company held more than $90 billion in cash and marketable securities. This is not a business approaching bankruptcy, but its costs grew much faster than revenue. Operating income declined, and capital expenditures reached just over $31 billion in the quarter. Operating cash flow was only about $800 million higher. Free cash flow fell by more than 90% from a year earlier. Meta also ended the quarter with almost $84 billion of long-term debt, up sharply from the end of the previous year. Again, that does not mean Meta is in immediate financial danger. Its balance sheet remains substantial. What it means is that the company has less freedom than the old Meta had. Money that once funded buybacks or accumulated as cash is now being converted into racks of compute. Investors are being asked to believe that better recommendations, smarter advertisements, new assistants, and future enterprise services will eventually produce a return large enough to justify annual capital spending between $130 billion and $145 billion. That may happen, but the latest free cash flow number tells us the bill is arriving before the full business model. Amazon is the same tension at a larger scale. Its latest quarterly sales exceeded $200 billion. Amazon Web Services grew about 37%, its fastest growth in 18 quarters. Management says demand is so strong that even a $220 billion capital budget may not be enough, and it describes demand stretching well into 2028. Those are powerful bullish signals. Customers are not disappearing. Cloud capacity is not sitting empty. But the cash flow statement is flashing red. Over the latest 12 months, free cash flow moved from a positive $18 billion to an outflow of about $7.5 billion. The infrastructure may be productive, but the company is installing it faster than current cash generation can absorb it. Alphabet presents another version of the same problem. Its latest quarterly revenue approached $120 billion, while Google Cloud revenue surged by more than 80%. This is not an AI product without customers. Demand is real, and management says it remains constrained by available capacity. Yet quarterly capital spending reached almost $45 billion, more than double the level 1 year earlier. Alphabet then raised its full-year capital budget to as much as $205 billion and warned that spending could rise again next year. Free cash flow fell sharply, and the stock declined as investors focused less on the spectacular cloud growth and more on the price required to produce it. Then we reach Microsoft, the company that currently gives the bulls their best argument. Microsoft reported quarterly revenue of $90 billion. Azure grew more than 40%. Operating cash flow climbed to more than $55 billion. After paying for capital assets, the company still had almost $20 billion of free cash flow. This matters. It proves that heavy AI investment and positive free cash flow can coexist. Microsoft's backlog is enormous. Customers are using more cloud capacity, and the company can sell AI through infrastructure, software subscriptions, coding tools, and enterprise applications. If anyone can turn the build-out into a durable cash machine, Microsoft appears closest. But even the strongest case contains a warning. Microsoft's quarterly capital spending reached $41 billion, roughly 2/3 of it devoted to shorter, lived assets such as processors. Cash paid for property and equipment during the full fiscal year rose almost 80%. Free cash flow remained positive, but it declined from the year earlier quarter because capital spending rose so quickly. Microsoft is not escaping the transformation. It is simply handling it better so far. Oracle shows what happens when the gap becomes more severe. Its fiscal year cloud infrastructure revenue grew 77%, and its backlog of contracted revenue reached hundreds of billions of dollars. On the surface, demand looks extraordinary. Yet Oracle generated about $32 billion in operating cash flow and finished the year with negative free cash flow of almost $24 billion. It raised $43 billion in debt and $5 billion in equity during the year, and it expects to raise roughly another $40 billion through debt and equity in the next fiscal year. A major credit rating agency cut Oracle's rating to one step above speculative grade, citing rising capital spending, weaker cash flow, and customer concentration. Oracle is the warning hidden inside the AI boom. A full order book does not automatically solve a funding problem. Contracts may be long-term. Data centers must be built. Now, customers may prepay for some chips, but land, power, cooling, construction, and financing still arrive on their own schedules. Across the 5 hyperscalers, external funding is becoming a larger part of the story. FactSet estimates that new debt represented only about 9% of capital spending 2 years ago. In the latest 12-month period, the share had risen to roughly 1/3. The companies are also using finance leases, operating leases, customer prepayments, and third-party data center structures to move some costs across time or outside the most obvious capital spending line. This does not mean a debt crisis is imminent. 4 of the 5 companies still have relatively low leverage and huge cash-producing businesses. But it does mean the old claim that big tech can fund everything effortlessly from internal cash is becoming less true. And once free cash flow shrinks, trade-offs become unavoidable. The first casualty may be share buybacks. For years, repurchases reduced share counts and supported earnings, per S-Hare. The second casualty may be investment outside AI. A dollar used for another graphics processor cannot also fund a speculative research project, an acquisition, or a new consumer product. The third casualty is financial flexibility. Debt and long leases create fixed obligations that remain even if demand disappoints. The bulls answer with one powerful fact: demand continues to exceed supply. Azure growth is accelerating. Amazon's cloud growth is the fastest it has been in years. Google Cloud is expanding at an extraordinary rate. Oracle's cloud infrastructure business is surging. These are not the empty websites of the dot-com era. The companies funding the boom are among the most profitable businesses ever created, and they are selling capacity to paying customers. That is why calling this a simple bubble is too easy. The bear case is not that artificial intelligence has no value. The bear case is that value may arrive too slowly while competition forces everyone to spend too quickly. Imagine 5 companies standing around a table. Every chief executive understands that spending less would protect cash flow, but each also knows that spending less could surrender the next computing platform to a rival. No one wants to be the first to slow down. So every company orders more chips, reserves more power, signs more leases, and builds more capacity. That is rational for each company individually and potentially destructive for the group collectively. There is another risk. AI models are becoming cheaper to run, and new chips are becoming more efficient. That sounds positive, but it can also pressure the price of compute. If the cost of intelligence falls faster than demand grows, customers benefit while infrastructure owners struggle to earn attractive returns on assets purchased at peak prices. Then comes depreciation. The current cash outflow will become tomorrow's accounting expense. As hundreds of billions of dollars of servers enter service, depreciation rises, energy bills rise, maintenance costs rise, and older equipment must be replaced. Even if free cash flow stabilizes, reported margins may face years of pressure. So, what should investors actually watch? First, ignore the excitement around a single revenue number and compare operating cash flow with capital spending. If operating cash grows slower than the build-out for several more quarters, the funding gap is real. Second, watch free cash flow, not just earnings, per S-Hare. Profit can benefit from long depreciation schedules and investment gains. Cash cannot be adjusted so easily. Third, compare cloud growth with capital spending growth. Strong cloud revenue is encouraging, but if revenue grows 30% while infrastructure spending grows 80%, the return still has to be proven. Fourth, watch management guidance. The most important pattern this year has not been the size of one estimate. It has been the repeated upward revision. Every few months, the finish line moves farther away. Fifth, watch debt, leases, and customer concentration. When a company needs outside financing to build capacity for a small number of giant customers, the credit market may reveal risk before the stock market does. And finally, watch buybacks. If the largest technology companies begin reducing capital returns to protect their AI budgets, ordinary shareholders will feel the infrastructure race directly. The $730 billion gamble is not proof that AI is failing. In some businesses, the technology is already producing visible revenue. Microsoft is the clearest example. Amazon, Alphabet, and Oracle are seeing powerful cloud demand. Meta says AI is improving the advertising engine that pays its bills. But revenue is not the finish line. Cash is big. Tech is not running out of cash in the literal sense. These companies still control enormous reserves, profitable platforms, and access to global capital markets. The phrase describes something subtler, and more important, their free cash flow is being consumed, their balance sheets are becoming more committed, and their room for error is shrinking. The next phase of the AI boom will therefore be decided by speed. Can AI revenue and operating cash flow accelerate before depreciation, replacement spending, leases, and interest costs catch up? Can the companies charge enough for intelligence to earn a return on the factories required to produce it? And can all of them win at the same time after building capacity as if each one will dominate the market? That is the $730 billion question. The gamble is not whether artificial intelligence works, it is whether it works fast enough. Because the first real crack in this boom may not be a bad model, an empty data center, or a dramatic bankruptcy. It may be something much quieter. One earnings call, one lower capital budget, and one chief executive finally admitting that the future is valuable, but not at any price.